Hi and welcome to this week's Property Insider video. Today Dr. Andrew Wilson busts some of the myths in the media, including talking about what's going to happen to interest rates, what's going to happen to employment. Hey, what happened to the recession? That's all over already. Rental markets, auction markets, lots more. So if you want to keep up to date with our regular property commentary, please subscribe to our YouTube channel and click the little bell icon to be updated each week. Fear of missing out, FOMO, seems to be a common theme around our Australian property markets at the moment. Auction clearance remain high, prices are continuing to rise, and supply remains constrained. And we're being played by the media. They're whipping up a frenzy with emotive headlines, causing some home buyers to worry the housing market's running away from them, while they worry others by speculating that interest rates are about to rise or that unemployment's going to escalate to 8% when JobKeeper ends. Now, the fact that we respond to these headlines, it's normal. After all, we're human, and the desire or the aspiration of buying your first home or upgrading your existing home or getting into the property investment ladder, look, that's normal. But let's bring some sense to this. So I'm looking forward to my discussion this week with Dr. Andrew Wilson, Australia's leading housing economist, to show us what's really happening in the property markets. Hi, Andrew.
Good morning, Michael. Yes, it's another day, another dollar with a commentary in the housing market. It's either a boom or a bust, let's face it.
Well, we'll unpack some of that as we go along. And our property markets, I guess, are in the midst of a broad-based boom. Housing values are continuing to rise in March. They continuing on from the first couple of months of this year. But we keep mentioning at the beginning of each of these shows the good real-time indicator of how buyers and sellers are feeling, which is auction clearance rates. And they're continuing their record-breaking activity, aren't they?
Yes, another big weekend in auction markets last weekend, Michael. Of course, it was the Labor Day long weekend in Melbourne. So we had significantly fewer auctions conducted. But interesting that we look at the number of auctions conducted in Melbourne over that weekend, they were actually higher than the same weekend last year. So I think vendors are still quite happy to move into the market and take advantage of strong competition from buyers. Look, Michael, we've got to really state that these are unprecedented times. These auction market results on the weekend, and the main auction markets are Melbourne, Sydney, Brisbane, Adelaide and Canberra, they're all now recording extraordinary clearance rates, 80, 90% weekend in and weekend out. We have never seen that before. And the Brisbane market particularly, I don't know what's happened to the Brisbane market, Michael, but we were used to saying that, oh, that's a good result when it was 55%. Now it's 85%. And it's just quite extraordinary. I think we are going to see record prices growth over the March quarter. I think one of the records that will be broken will be if we look at the national average of prices growth for each of the capital cities over the March quarter. I think that will be a record result. And normally national house prices are based on the volume per market. So obviously Melbourne and Sydney with more sales dominate in terms of that so-called national price. Of course, and that's meaningless because if it's all Melbourne and Sydney, well, it's not really a national price, is it? It's downgrading what could be equally strong results in Hobart or Darwin. But I think that if we average it out rather than look at that weighted average based on observations, listings, we may see a record because there's so much consistency in this market now across the board.
You're right. Look, I've been following auctions. I've enjoyed the street theatre of auctions for close to 50 years now, and I have never seen it this way. But while our housing markets are very resilient and they've done well through COVID, now they're surging, the rental markets, well, they've been a bit fragmented, haven't they, Andrew?
Yes, Michael. The latest data from My Housing Market for February again shows a disparity between, as you suggested, between house rents and unit rents. My Housing Market produces vacancy rates for individual house and unit categories, unlike most of the other vacancy rate modelers. And we can see there that the high vacancy rates overall in Melbourne and Sydney are really a product of very, very high vacancy rates in units. And those high vacancy rates are certainly in the CBD areas. If we do separate those houses from units, Michael, we see it's actually quite tight for houses. If we look at the rental growth, we can see rental growth continuing for houses, but certainly on the slide for units. And again, when we look at where the rental weakness is, it is in those inner city CBD markets. Now, even though we did see a slight reduction in vacancy rates for units in Sydney and Melbourne over February, really it was only marginal. And it was a product of seasonal factors because in February, of course, we always have higher demand as the holiday period finishes and tenants start thinking about moving to new properties, or else new tenants enter the market. But that's still very much a mixed bag, as you suggested, Michael. Tough for landlords in those CBD markets in Melbourne and Sydney, but much better ride out there for houses, and vacancy rates are certainly tightening for houses and rents are rising.
Well, it's unlikely that those inner CBD high-rise tower apartments are
Yeah.
going to start filling up until our international borders are open, students come back, Airbnb come into the market. But Andrew, there was a lot of talk about a recession last year, and we talked about what was it going to look like, a V shape, a U shape, a Nike swipe. But last week's economic data showed our economy continues to rebound, with the fourth quarter GDP beating most expectations. It rose by 3.1% over the quarter. And Andrew, this was driven by broad-based activity. It wasn't only consumers. I was interested to see businesses now back to investing in machinery and equipment, and government demands growing. So this is looking positive for our economy.
Well, yeah, it's really disappeared from the media lexicon, the word recession, hasn't it, Michael? In fact, if we remember our famous Prime Minister, Mr. Keating, when we had our previous recession in the early 90s, he famously was quoted as saying, this was the recession we had to have. I'm saying this is the recession we never had, because it wasn't really a recession, Michael. We had a very slight easing of economic activity over the March quarter last year, down by just 0.3%. And the economy up to then was a little mixed anyway. And then of course, we had the coronavirus slide, and that was down over 7%. And then we've been back in town quite strongly. Haven't quite made up what we lost in the March and June quarters, but we will certainly do that over the next quarterly data that we get. And, as I said, that it really hasn't been a recession at all, as we would, I guess, understand in classical terms. Yes, we had 2 quarters of consecutive economic growth, lower GDP, but really it was that black swan event just kicking the economy over the June quarter, and we've bounced back quite strongly, as you suggested.
Well, technically, it was a recession, as you
Yes.
say, with the 2 quarters, but it was a recession the government made us have, and it quickly pulled us out of it. And one of the factors that people were talking about then was unemployment. It was going to get to 10% to
Yes.
20%. And in my introduction, I mentioned how some media commentators are back at it again. They're worried unemployment's going to rise when JobKeeper ends. But recently, NAB and SEEK, the employment website, showed that there's been really strong growth in job ads. In other words, it's signalling that our labour market could tighten faster than many expected, and unemployment could fall faster. But I just remember week after week, you've been suggesting that anyway.
Yes, well, again, a lot of those gobbledygook headline chasing negative job predictions. The cliff has also gone out of the lexicon of the media and commentators. I don't think they're expecting any noticeable change in the employment market after the end of JobKeeper at the end of March. And although, of course, it will have an impact, let's not downgrade that on some that have been using it to support their incomes. We've had the offset to that, which has been plenty of jobs being produced and aggregated incomes increasing as a result. So we've had a great run, Michael. The Australian economy has bounced back. I think that we will continue to see unemployment rates in the low sixes. And as we gather even more momentum, I think we'll move into the fives this year. And again, I guess there'll be another conversation around the prospects for the housing market and the labour market going forward. But it's been a very positive result out of the coronavirus shutdowns, both in terms of the labour market and our economic growth.
Well, while we're on to those things the media is scaring us about, it's
Yeah.
worrying people, suggesting that interest rates are going to rise.
Yes.
They've got to go up, Andrew, they say, because look at our booming housing market. What would you say to those people?
Well, why does it have to go up, Michael? Why does everything stay the same? We've never had interest rates this low, which is basically 0.1% official rate, which is 0. While we've had house prices at growth at this level, usually it's a sharp decline in interest rates that drives house prices at this level, but it's really the catch-up energy that's driving the market. And as you suggested, a lot of momentum, a lot of FOMO. Buyers are wanting to get in on the action, and most buyers are sellers and sellers are buyers. And the prospects for higher interest rates, you cannot make a case other than saying, well, it could happen, couldn't it? Well, anything could happen, couldn't it? Because logically, there is no economic case for higher interest rates in the foreseeable future. And the foreseeable future is as long as we can foresee. We had this, again, the speculation started to run because the chairman of the Fed last week, Mr. Powell, stated that his comments regarding the outlook for inflation were perceived as being indicating that perhaps inflation might start to rise over time. And of course, straight away, the market's hanging on to every little thread they can to try to, of course, the markets want to have some change because they can't make money unless there's a changing market. They need a margin. So long-term bonds started to increase because it was factored in that this meant that interest rates would rise over time. Let's be very clear. This is simple. And I speak to all the economists out here. Throw your textbooks away, especially your macroeconomic textbooks. Just stick to the micro. And microeconomics, the fundamental of all economics is the law of supply and demand. And until we have a significant excess of demand over supply, we will have no inflation in our economies. That's the bottom line. That's what we look for on the ground. Too much demand, not enough supply, pushing up prices, increasing inflation, and eventually resulting in higher interest rates. This conversation regarding higher interest rates is all about putting the cart before the horse. You won't get inflation or higher interest rates or higher long-term bond yields until you have an excess of demand over supply, Michael. I'm sorry to harangue you with this, but I think it's very important. And the point is that even with the Reserve Bank governor stating that we need to have an unemployment rate in the 4s before he reckons that inflation will start rising and therefore followed by interest rates, we were having trouble with the low 5s with getting inflation up and incomes growth up. There's no guarantee that even if we did get to a 4% unemployment rate, that we would have inflation and incomes growth occurring as a result. Again, we're looking backwards and pretending it's a magic pudding and everything stays the same. The US got into the 3%, Michael, with its unemployment rate and still couldn't generate any incomes or any inflation. So let's just forget about higher interest rates. Let's turn the conversation into something a lot more rational, please. Although I think that we're stuck with this for the longer term, Michael, until it finally gets through that this is a completely different environment now that we are in.
The problem is people are listening to those experts on YouTube and experts on Facebook, and they're being a bit worried by them. Now, Andrew, our weekly Property Insider videos are being watched by thousands and thousands of people, and they actually attract a great deal of commentary. Some people agree with us. Clearly, some have a very opposite view. Now, that doesn't concern me because opposing views is what creates markets, isn't it?
Absolutely.
However, one regular viewer left a following question on YouTube. So I'd like your thoughts on a question left by somebody who calls himself just a middle-aged bloke. And he leaves comments every week. And he said, "Thank you for the fantastic comment. I was wondering if I could ask Dr. Wilson to explain to some common folk the mechanism behind which significantly rising sovereign bond yields could end up raising borrowing costs for consumers, the masses." He goes on to say, "After all, surely the big macro issues like these could potentially have a bigger impact on house prices as much as the impact of unemployment and the like." Now, you've
Well,
partly answered that anyway, Andrew, but what would you say to just a middle-aged bloke?
Well, look, sovereign bonds are nothing to do with the macroeconomy per se. The macroeconomy is those issues of supply and demand. Now, bonds are just a reflection of what is happening in the macroeconomy. When people will buy a debenture and the rate of return on that debenture is based on the underlying rate of return in the economy. Now, if our economy is heating up, then interest rates will rise. Now, longer term bonds obviously tap into perceptions of what the market may be in the future. Now, as I said, that's all about perceptions, not reality. Reality now quite clearly is that there is no prospect of inflation, higher incomes, or higher inflation, higher incomes, and therefore higher interest rates until our economies at least pick themselves up off the floor. And that's why longer term bond rates will remain reasonably consistent. But they vary, Michael, as speculation moves in and out of the marketplace. And you've got to understand that traders are working on that speculation. Of course, other factors that create interest in sovereign bonds are the actual nature of the local sovereign economies. And we've seen quite a strong appetite, particularly for Australian government bonds, both at the Commonwealth and the state level, because our economy is doing well. But our interest rate differentials are not that significant. And that's all about a creditworthiness perception, Michael. But our interest rates are not that different from anywhere else in terms of those longer term rates, because we are a hostage to what the fundamentals are in our economy. And until we get more people in work and we get that increase in demand over supply consistently, pushing up prices, we can forget about any sense of a higher interest rate outcome. I hope that's explained that, Michael. It is, as I said, putting the cart before the horse to some degree. Let's look at what's happening now. It's just tea leaf reading to speculate that in 10 years' time we're going to have high interest rates and higher inflation. The GFC, Michael, is more than 10 years past, and we've created no inflation, no incomes growth in the last 12 years since then. That's all about the future, isn't it? And that's learning from the past. But it's a cheap headline, Michael, and it helps with arbitrage and all those traders that are looking for a margin. So just look at the fundamentals, Michael. That's my advice.
Well, I think that's what we have to go by, the fundamentals and evidence-based discussion
Yeah.
rather than fear and speculation, which the media loves. And we understand it's not their job to educate us.
No,
It's their
no.
job to entertain us. It's their job to get our eyes onto their
Yeah.
websites because they've already sold the space to advertisers. They've sold our time to them. So I look forward to having a regular chat
Yes.
with you each week and bringing some sense to the property markets and the economy. Thanks for your time, Andrew.
Thank you very much, Michael.